Welcome to Industry Insights. Thank you for joining today's episode, Avoid Your Own Real Estate Crash. And as always, we know how valuable your time is, and we want to assure you, no matter what role you have in the real estate world right now, this is going to be time well spent. It is my pleasure to introduce today's special guest, Eddie Wilson. Eddie Wilson is the CEO and president of ThinkRealty, a real estate investment media platform that includes a magazine, digital content, events, and one of the most comprehensive discount programs available in the industry. He is also CEO of American Association of Private Lenders, which is the largest association of private lenders in the country. And Civic has been partners with them for a long time. Eddie is a husband, a father. He is an avid real estate investor. He is a national speaker and an entrepreneur who has a passion for business growth. So over the course of his career, he's either built or run more than 100 different businesses, managed 4,000 employees, and just traveled around the world speaking to his business and leadership expertise, as well as scaling his companies. We are thrilled that you are here, Eddie, to share your real estate insight and experience with us today. So welcome.
Thank you so much. Glad to be with you.
Taking the mic with Eddie is our president and CEO of Civic Financial Services, Bill Tessar. With over 35 years in the mortgage industry, Bill is just a true visionary lending leader. He continues to elevate the private lending space. And since joining Civic in 2017, he has led Civic to achieve some major milestones. He's developed the people and culture that continue to make Civic so successful today. He is a Glassdoor top CEO. He's been named a Housing Wire Vanguard Award recipient and is just truly a leading voice in the lending industry, which is how this platform of Industry Insights was started. He just gives you real talk on real estate investing, no matter what the landscape looks like. And without any further ado, kicking things off today is the man of the hour, Bill Tessar.
Thank you, Gina and Eddie and everyone joining us. I'd be remiss not to share when Eddie and I were talking about this event and really getting to know each other better. I hung up the phone going, really, if you think about 35 years in the business, there's, an awful lot on my resume I'm proud of. And I walked out of that meeting going, holy crap, I got to get to work. I mean, this guy, Eddie, is a mover and a shaker and has done some incredible things and continues to do incredible things. And what I think I like most about Eddie, and what I think you'll all find very valuable is, this is a guy that's actually walking the walk. A lot of people out there can reiterate stats and point to market movements, but this guy's actually walking the walk. So thank you, Eddie. I mean, I think this is going to be a great 45, 50 minutes together, and I think everyone's going to get something out of it. So if you don't mind, I'm going to jump right in.
Yeah, let's do it.
So, there's so many articles written about staying competitive in the real estate marketplace, especially now that we're calling it booming real estate. And I think it depends a little bit on the investor and what type of investor you are. So like different risk tolerances, and we talked a little bit about this, but why don't you share with me those different risk tolerances and how they're approaching this booming real estate market and maybe some takeaways for the folks on the call.
Sure, absolutely. So I think that, people have to, first of all, set their strategy as to how they're going to attack the marketplace. For me, I'm an aggressive real estate investor. I'm a third generation real estate investor. Grandpa's a real estate investor. Dad's a real estate investor. And where my grandfather's, kind of in the twilight of his life in his 90s, obviously he's going to be less risk tolerant than I am in my 40s. And for me, I believe that any real estate cycle you're in, there provides opportunity. Even today, when people are running out of New York or California, I'm actually running in. I'm seeing the opportunities and trying to maximize the opportunity there. As any real estate investor sees, when there's a vacuum in any market, in any turning of the economy, we have to be prudent enough to see the opportunity and go after it, because that's really where wealth and generational wealth is made. So I think that obviously you have to have kind of an understanding of your risk tolerance. And then based on that, I think that you have to go chase those vacuums, those opportunities, those market conditions. Whether it's a bear market or bull market, real estate investors that are savvy always make money. And so, for me, I try to take advantage of every opportunity that I see, and make sure that I'm trying to be astute enough that if people are moving in any direction, I'm watching for the opportunity in that, aggressive non-movement. And so, like I said, New York, there's a ton of opportunity in commercial real estate development right now in New York. You've got this massive flight. You have people not renewing leases. You have a fear in the marketplace for commercial holdings. And so for me, I'm looking at those opportunities and taking advantage of them. I've bought commercial assets in New York in the past 6 months. Same thing with New York. I've been more aggressive with my multifamily investing in New York. And people say, well, they don't have, great landlord laws in New York, or they really are there to protect the tenant. Well, the thing is when scared money is running, they're leaving money on the table. And for me as a real estate investor, I'm going after it.
Yeah, that was kind of an aha moment in our discussion. I've heard a lot of people still investing in California. I hadn't heard a lot about that in New York. Now the numbers just came out. I think Manhattan alone was up in historic numbers. I think they just crossed, was it $10 billion in sales
Yes.
recently? And that was depressed quite a bit as COVID hit them, wiped them out. So I did think that, there was a huge takeaway as we thought about that part of the bookend. And it's probably a good segue for strategy. So with all that's going on, are you advising your people to buy, to sell, to rent? I had a conversation with Greg Geiser, who's the CEO of Wedgwood, and he told me, we were talking about Manhattan Beach, and Manhattan Beach has gone up, I think, 18% year over year since COVID, like crazy numbers. And there's an awful lot of owners of real estate in our corporate office in Manhattan Beach, and a lot of discussion about taking chips off the table. And, I think his feeling is still historic low inventory. Why would you do that? Like, you're not taking chips off, you're leaving chips on. And I just wondered what your thought was on from buy, sell, rent. Like, what are you thinking?
I feel the same way. Being a real estate investor now for over 20 years, the only thing I lament is any deal I've sold. It's like I never lament the deal I passed on. I never lament the deal that I didn't see come to fruition. I lament those deals, those assets that I had that I decided to sell, because historically you feel like you're making the right choice. The numbers all match up. So for me, I'm a buy and hold guy. I've got close to 4,000 doors. For me, I'm extremely bullish when it comes to real estate. And there's factors at play here that no matter what, and I've you read the pundits and you see these billionaires that are, well, you read Robert Kiyosaki and he's storing away gold and precious metals in all the different countries waiting for this massive historic crash. You've got other guys out there like him. But then you also have, the other billionaires that are like, what, like we're so underbuilt in the real estate market that even if the market crashed and we lost 30% of the top end of the market, we still couldn't satisfy the demand that's there. And so for me, I look at the demand and supply issue as the rudimentary source for most of my decision making. And the reality of it is I'm down in South Florida right now. I'm not at my home. I'm down here investing in real estate, and we're building properties in South Florida. So I want to take advantage of the boom here as well. And the thing is there's 10,000 residents moving into the area that I'm building in right now. There was only 140 building permits pulled last quarter, in fourth quarter, 140 building permits in my area and 10,000 residents moving in.
We talked a little bit about supply and demand, right? And I think the numbers you and I have seen have ranged between 4.5 million to 6 million homes under that supply and demand curve. You want to talk a little bit about that? Like,
sure.
I mean, what I said to you was I thought it was 9 to 10 years of aggressive building to create some equilibrium. Then you threw that math at me and that stat. And then I start going like, we're going the opposite way.
We are going the opposite way. We're underbuilding even for the demand that's there. And so even when you look at depressed markets, like maybe in New York or others, you're still seeing staggering numbers come out of Manhattan and other places because the demand is still there. And some pundits would say that it's an overinflated or a hyperinflated marketplace that's causing that. The Fed printed money, therefore money's in ready supply, therefore the prices are going up. It does not, it still does not solve the problem that there are bodies that need houses, and there's not enough houses to service the bodies. So even if you had this hyperinflated society or economic, kind of sustenance, if you just cut the top 25-30% off, if there really is truly hyperinflation, which is, that would be what hyperinflation is, right? 20-30% over what it should be. If you cut that off, the math still makes sense in the favor of real estate investors that are going after the assets. I think that there's a strategic way to go after it. I would not recommend over leveraging assets. I think it's a little dangerous right now to be leveraging assets at 85-90%. My CPA, my CFO, and my architect for taxes, we decided that we were going to leverage to about 65% for most of my portfolio. Because I want to go after all the new opportunities, but I also don't want to get so focused on getting this cheap money that's out there right now that I open myself up for liabilities down the road.
Yeah, I think that discipline, Eddie, is something that is missed by a lot of investors. We had a really, really large investor, 700 or 800 properties that investor had. I don't know if you guys subtly caught Eddie dropping the 44,500 doors he has, but that's through 20 years. And that is a buy and hold mentality that he has incorporated for the last 2 decades, which is very impressive. But this gentleman had 700-800 homes, and he was levered. He was levered slightly above 80. There was a hiccup with a partner, and next thing you know, he's liquidating assets over the last 12 months when those houses were still appreciating, and he's liquidating them quick at a discount for guys like you and others to buy. So I do think the whole leverage thing, and we do see some lenders in the marketplace that are doing the 90s in an inflated market with no correction that's taken place over the last 4 or 5 years, like real correction. It does seem risky to me. And so I appreciate you bringing that up.
And I might fudge that number a little bit. Like, for instance, I've got some multifamily development down here in South Florida. I may take 90% on the land to make the deal work. I may take 90% on the build cost, knowing that by the time that my sticks and bricks are up, the appreciation of that asset is probably going to fall in the 75% range. And so in some of the bigger, more isolated opportunities, I may leverage that high, but for my standard, buy and hold doors, 65% is my tolerance today.
I got 80 account executives lined up outside my door that want to chop up your 40 and start presenting you with real estate refinance options.
I know they do. I know. I actually saw a bunch of them in the crowd too.
Oh, you did?
Yeah.
You've seen them at some of the conferences as well.
Yeah.
Yeah. So, hey, a lot of talk about interest rates. You saw Powell going through with the Senate yesterday in his confirmation hearings, and we've heard talks from 2 to 4 rate hikes over the next 12 months. I think if any of you are following interest rates, the one I followed for my career is a 10-year. The 10-year is sitting like around 171, 172, I think, off of yesterday's high of 175. I spent 30 years on the conventional side of lending, and all my contacts there have seen interest rates that were dabbling in the 2s now touching up against the 4s. Any impact you see, or either to you or to others, as interest rates rise, what you think that's going to mean for the marketplace?
Sure. Yeah, I think what's happening is the people that have underleveraged assets are getting aggressive right now to take advantage of the cheap money. They know that a hike is coming. I mean, the Federal Reserve, 2 months ago, kind of already projected we're going to raise rates most likely 3 times in the next 18 months. It's probably going to be 0.25% each time. That's kind of the speculative thing that was leaked out there. But the reality of it is this is a crazy dynamic. So one of the benefits of having both ThinkRealty and the American Association of Private Lenders, I get to talk to economists all the time. I'm not an economist myself, but I get to glean from all of them. And I was talking to Doug Duncan, who's the chief economist for Fannie Mae. And And Doug gave me this stat. Now, this stat seems crazy to me. He said, if we actually raised interest rates to the degree of the highest point that we've ever had in our nation's history, which I think he quoted it somewhere in the around the neighborhood of 26%. He said, if we raised interest rates, yeah, like Carter years, 26%. He said, do you know how much time it would take to just counterbalance the money that the Federal Reserve printed over the past 2 years? And he said, obviously the Federal Reserve is a counter-inflationary, piece there. He said, if we raised interest rates to 26%, it would still take 9 years to counterbalance what was printed over the past 2. He was like, we're playing at a disadvantage right now because none of the numbers and metrics make sense. It's too hard for us to get our minds around it. And then with people playing with the inflation index and taking things like lumber out or food out, it's, the CPI is kind of a joke right now. We see numbers that are above 6. But a lot of people believe that the inflation is around 15, and so it's like to raise an interest rate 1% or 2% is really not going to do much against that inflation.
And I think we're talking about that historic low. So I was talking to one of my buddies who's been in the business a long time, and he's a lender at a publicly traded firm. And he was telling me what I was telling you about rates coming into the 4s, but it's like, just gain perspective for a second. Like we were literally in the 2s for 3 years. And right, so, yeah, some people got to squirrel away low rates, but I think what you end up seeing happening, Eddie, is that as rates do go up, if the long-term 30-year fix goes to the 4s, what you're going to see is a lot more 10-1 interest onlys, 7-1 interest onlys, buy-down mortgages, qualifying at the start rates, graduated payment mortgages. The lending industry is a big machine, much bigger than the space you and I operate in. The actual conventional lending space is multi-trillions of dollars every year. So they're not going to have a shortage of answers to the refis that go away because rates go up. So my truth is that you might not see the 30-year fixed at 2, but you're going to see a plethora of other loan programs that you haven't seen in a while work their way back into the marketplace to make it more advantageous to people borrowing again. And
I think that's a great truth, and I would wholly agree with you. Because in the end, we have to go back to that conversation of there's a supply issue, and in order to satisfy the supply issue, lenders are going to have to find a way to lend money. Lenders are creative, right? Like when these interest rates go up, here's the one thing that I do potentially see is I think that there is some hyperactivity when it comes to the appreciation of some of these assets. And I could see an interest rate hike curtailing some of that massive appreciation rise, because people are not going to pay the stupid rates anymore when it's more difficult to get the capital. And so, or they're not going to set themselves up when they're working on, a 5-year with an ARM or something like that. They're going to be very careful in the capital that they take to take down these assets. And so, but I believe like you, I think the money is just going to move from one pocket into the other because we still have a supply and demand issue.
So like you're an extreme with as many doors as you have, but what are you thinking about in terms of financing strategy? And let's really target more of someone that has 5 to 15 assets, and we could talk about the bigger behemoths in a second. Sure. But what are you thinking about with rates as low as they are? Are you taking down a 15-year and biting the bullet for the next number of years to get the principal reduced, or is it a cash flow game and 10-1 IO and play that out?
I really think it goes back to strategy. For me, I always play the long-term game. And so my goal is always to allow tenants to pay the payment and create cash flow, or at least an acceptable amount of cash flow, so that in 30 years, this is a free and clear asset for me that I could go back, leverage, go buy more. That's my strategy. So I think your financing strategy just has to resemble your investing strategy. I know others that have a more accelerated process. They're trying to make money on their deals within the next 5 years. they may have to bite the bullet. They may have to buy points. They may have to do, create activity to try to create a strategy and a pathway to get them where they want to go. I think it's more of a timing issue than a strategy issue.
So, like, thinking about that for a second, because this has been a debate over here at Civic for at least the last couple of years, as we've watched the rental part of our space, about the private lending space, take off. Like right now, the 5-1, 7-1, 10-1 rivals conventional interest rates right now, and it's no income and no documentation, 4 months reserve type of thing. But the thing that's got me, like, I struggle with it a little bit, like this demand for a 30-year product. Like, if you just think about the amortization, the cash flow associated with a 30-year, just do the math, pull up an amortization schedule on Google and do the numbers, and then do a 10-1 IO. That cash flow differentiation between the two is substantial. And a lot of people aren't like you, Eddie. They don't come from 3 generations of real estate investors. They're not buy and hold. They're not accumulating hundreds, if not thousands of assets. There is a gain. They're going to get some appreciation. They're going to get some cash flow. That cash flow is going to be used for some other project or program. And so I just haven't totally got my arms around the 30-year fixed play. Do you have a feeling on that?
Yeah, I really don't. I think you're the expert in that space for sure. I mean, I love my role at the American Association of Private Lenders, but I don't, consider myself to be a very astute lender. I believe I'm an astute borrower, and I know how to borrow to service my need. And so for me, there's so many interesting documents out there. I've got a friend named Aaron Chapman, who's a conventional mortgage originator, and Aaron has this document, and he shows this 30-year note, and if you never refinance, how the numbers of it's the craziest thing when you watch kind of like inflation versus the current interest rate. It's like you end up actually making more money on the tenant paying up. I see this document. I'll send it to you sometime.
Please. Yeah, please do.
And it's just this fascinating look at what so many people are missing by not going after the 30-year. But I don't know. I think the 30-year, we're in jeopardy of kind of seeing that go away a little bit because of Wall Street's involvement in it. When interest rates go up, Wall Street money, I think, will get a little bit more stringent. And when Wall Street money gets a little bit more stringent, I think those rates that you're talking about, the 10-1, the 7-1s, those are going to be, extremely popular because it's going to be harder to get to the big 30-year.
Yeah, we talked a little bit earlier about different markets when it comes to discerning being in here or there. And you talked about traveling into the eye of the storm. When people are leaving, you're going in there. But best and worst markets right now, I don't think there's anybody here from North Dakota, right? Gina, are we good on that? Neither of us.
I did not see anybody from North Dakota.
It's not on my list of approved states yet. So for anybody from North Dakota, accept mine and Eddie's apology in advance.
That's funny.
Let's start with maybe markets you're staying away from right now.
Yeah, so the markets I'm staying away from right now are the ones that I'm not seeing appreciation opportunities. The Rust Belt states have been really significant in people building long-term cash flow. The turnkey provider out there has loved the Rust Belt states, the Ohio, the Michigans, the Buffalo, New Yorks, Pennsylvania, and they've really done well. For me, I think that opportunity is going to be a slow opportunity over the next 10 to 15 years. If appreciation begins to slow because of all the flight south and west, I think those states, you're going to have the hardest time finding the opportunity that you maybe once had 6-8 years ago. I sold a whole portfolio, and I typically don't sell in Kansas City, Missouri, because I felt like the median income of that market had surpassed the ability to allow my rent rates to continue to grow. And with the rent rates not able to grow and appreciation really not being a big factor in Kansas City in the areas I was in, It just didn't make sense for me to hold on to that smaller portfolio. So I sold the whole thing. So I still love the Smile states, the states that all the lenders love to. I love Texas. I love Florida. I love the southern states, Georgia. There's so much movement in those areas. It's like you kind of just put a pin in the map and you can make money. There's opportunity everywhere. However, I'm kind of staying away from those Rust Belt states. I think if you kind of bookend the country and you go California, New York, I think if you're very intentional, there's lots of money to be made. I think if you're not intentional and maybe you're more of a novice, I would stick with, places where you're watching all this flight go. You watch Boise, Idaho is one of the hottest markets in America right now. According to so many economists, and it's all of that movement from Northern California into some of those Western states, and Boise has been the recipient of it. And Salt Lake City, Utah, Boise, Idaho, Jackson, Wyoming. You name any of those, bigger kind of burgeoning, growing areas in those Western states, and they're all a great opportunity. I saw a stat, I think last week, that Coeur d'Alene, Idaho has seen 400% growth in its population, and it's seen almost 600% growth in its home values over the past 3 years. And so you look at places like Coeur d'Alene, Idaho, there's so many random places to make money today. But I do love the South, all the flight, and I'm calling them the flight states. If somebody's moving from somewhere, going to somewhere, you just need to beat them there and buy the real estate.
Yeah, I like the flight state reference. What we did here at Civic when COVID hit, we changed our entire model and we called it Civic Anywhere. And so today and forever, long past COVID, we have a widespread out. Our employees, a third of them work full-time at home, third of them are hybrid, third of them are here. And what I saw was the same thing you talked about. So our headquarters is in Manhattan Beach. We had people move their families to Vegas, to Arizona, to Florida, to Texas, to North and South Carolina, to Tennessee. They just went inwards. And I think it's more than, hey, there's a real estate opportunity. The state tax situation is better than in California and New York. So they're keeping more of their dollar. The dollar spends a little bit more wider when you go to a Texas compared to a California or an Arizona. And I think people, now that they don't have to work in corporate America, shoulder to shoulder, are saying this is a once in a lifetime event that I can go live where I want to go. I can go make more, keep more than I make. It spends a little bit better. The housing is better. We had one executive leave a 1,100 square foot home in Manhattan Beach, 2-bedroom, 1 bath. That was like $1.5 million, 2 plus 1 million and a half, and goes to South Carolina, gets a 5-bedroom, 5 bath on a 1/4 acre with a lake. Same deal, lower state taxes, gets to raise a young family in a way that you never could have done here at Manhattan Beach. And so I do also think that that's probably going to balance this whole demand thing in a way that keeps real estate appreciating for years to come. People are educating their kids at home. They're bringing their parents home, and instead of convalescent home, they're working out of their home. So home sweet home has a different meaning today than it did pre-COVID. And all of that means less people are selling, more people are expanding, more rehab, ADUs, and that sort of thing. So it's an interesting time, for sure. But I'm in alignment with you in terms of where you're thinking about states. I will say you're still the first speaker that's ran to New York. So I do like that.
Yeah.
I think everyone should take note of it.
I think, what's interesting is I just talked to yesterday, I met with an investor down here in South Florida. Same deal. He moved from the Albany, New York area down to South Florida. And we're looking at a deal together down here. And same thing, he said, with Florida not having a state income tax, he said his was 8.25 or something. So he said, I immediately got 8.25. He said, I reduced my tax. He said, for my house, he said, I bought a waterfront property here in Redington Beach, by the Tampa area. He said, I reduced my annual taxes from, I think it was $30,000 a month in Albany to same valued property. Now he lives on saltwater, with a boat. and his taxes, I think, are $3,000 a year. It's crazy, crazy stuff. Like the numbers just get ridiculous. Then he moved his businesses down here, and then his businesses and enjoy a better corporate tax here in Florida. So he was like, the windfall of capital coming my way. He said, I don't even know how to use it. He was looking for investment opportunities. So it's just they get here. Yeah, I know, we all will, right? And but it's like they get here and then they realize there's even more opportunity than what they expected. So
yeah, I mean, I don't think I've ever had anything, and I've been in California for over 50 years, and I don't think I've ever had a time where I have contemplated housing outside of the state. It becomes, it's almost indefensible. And trust me, the mind games that go on between the ears throughout the day as you're paying the highest state tax in America is something I'm reminded that the ocean makes it all better, but I'm starting not to listen to that argument as much.
Yeah.
I want to ask two more questions before we go to Q&A. What about the tax play? Like you and I had a great conversation. What's the talk? It's cash flow, it's appreciation, but the real, actually probably the biggest play if you're a long-term player is really the tax benefits of real estate. So touch a little bit on that, Eddie.
Yeah, so I think people listening to me on the call may think that I'm a real estate investor, and I don't actually believe that I am a real estate investor. I do have lots of doors. I'm a business builder. For me, I've built over 100 businesses in my career. I've exited 76 of them. I exited 76 of them in 2019, right before COVID, sold 76 of those businesses, went from 4,000 employees to about 40 employees right before COVID, and had no idea it was coming.
You look very relaxed.
Yeah, way relaxed. The ocean's out the window here, and buying some Florida real estate. But it's interesting because I am a business builder. I love businesses. I'm a tactical, operational, roll up the sleeves guy. I love scaling businesses. The problem with building businesses, unlike buying real estate, is it actually provides you, the bigger the business you build, the more tax liability you create. And so the economy works against you when you are a business builder. The more wealth you amass, the more tax burden you have. The bigger the business, the greater the liability. So for me, real estate investing is really more about the preservation and legacy of the wealth I've created out of the businesses that I've had. I've had massive liquidity events, but the way that I offset those liquidity events is through buying real estate. And so why, buying real estate in California right now makes a lot of sense to me is because oftentimes I'm not looking at am I getting a 7 cap or an 8 cap or a 9 cap? What I'm looking at is the taxable benefit back to me to offset my non-W-2 income, all those businesses that I have. And so for me, the windfall is if I can cost seg those assets and I can buy deep, then the appreciation and the opportunity there in those assets, as long as they remain, kind of in a stable condition, I could end up with a net of 18, 19, 20% of value back to me. So it doesn't matter if I'm getting a 3 or a 4, because the tax offset to me, because of cost seg, allows me to keep more money in my pocket from my non-W-2 income. And so for me, that's why I've got 4,000 doors, is because I'm not necessarily just trying to amass wealth or just trying to find the highest cash on cash return. Oftentimes what I'm doing is trying to offset my taxable liability. That's the game that the wealthy play. I was, the beneficiary of having a grandfather and father who has played this game before me, and by osmosis, learned all of these tricks and tips to offset my tax liabilities. And in doing so, I've amassed a large portfolio that then I can pass on. And then the taxable benefit of passing it on and, passing on real estate, has all kinds of opportunities there. And obviously you can go down that path as deep as you want.
Yeah. So Eddie's new company, Eddie's Tax Play in Real Estate, is starting in February of 2022. Yeah. We'll give you his number for that. So look, here's the biggie. I talked to one of your gentlemen last week on a ThinkRealty podcast, and it was interesting because he spent a lot of time on the Black Swan event. And so like, let's just take a step back. You go into the financial crisis, and what a lot of people who didn't go through it don't know, and some may not remember, is the financial crisis happened because loans were being lent to people that they shouldn't have been.
Right.
There were 100% loan to value loans up to $1 million for second properties with no income, no asset, and FICO's at 580. Like, all of the indicators of problems at the highest apex point of the market, massively inflated market. We're doing 100 stated second home 580s to people that really didn't qualify. And Wall Street was buying that paper. And the second the market corrected a little bit, people were like, man, I'm underwater 10, 15%. I'm either going to collect rents and keep this as long as that foreclosure game goes, or give the keys back. And it was massive. Today, the cleanest paper we've ever done. Average FICO is over 730 nationwide. Average LTV, 75 LTV, not 110. Very difficult to get a loan. You know, Eddie, go to get a conventional loan. No matter how qualified you are, no matter how much experience, your package is that big, right? So a lot of the newbies, a lot of people that maybe came out of the tail end of that are saying the black swan event is coming. The black swan event is coming. So let's talk about your feelings about that, whether you believe there's something around the corner we got to be careful of, or the opposite of that, and why.
Yeah. I think the black swan event already happened. I think COVID was the black swan event. You know, it was the unexpected event that nobody could prepare for. That's by definition what a black swan event is, you know, that then changes the entire way we do, you know, life and you know, business. One interesting stat is that in any recessive period in history, whether it's a depression or recession, there has never been two successive recessions or depressions that have been in the same industry. What happens is things like Dodd-Frank happen right after the massive crash, right? And overcorrection. I sat on a subcommittee for finance that helped modify Dodd-Frank. My point was point number 3 that helped determine what liabilities banks could now take on. So in the modification, because even the government realized that Dodd-Frank was a little bit of overreach. It was you know, them going too far. It was the knee-jerk reaction. But that knee-jerk reaction in any crash, in any recession, in any depression, always prevents it from happening again. I think the correction is exactly what we're experiencing, where you talk about how clean the paper is, you know, how under leveraged these assets are, you know, how safe it has been for Wall Street, private lenders, private capital, conventional capital, all to come into this marketplace and make sure that we don't have the financial crisis that we had. I do believe, however, there is going to be a market correction. I don't know what that correction is, but I am almost positive that it's not going to happen inside of the financial world or the residential housing world. There's just too many factors that play against this. You know, I could totally see you know, corrections coming in other industries. There's a lot of market indicators that show that there could be something on the horizon. Economists are warning everybody. They always have the magic 18 months, you know, and 18 months, you know, I don't know why every economist touts 18 months, but it's always 18 months no matter when you ask them.
Yeah, they have a talking point for a year and a half. So.
Right.
Yeah.
And I could see it, you know. I think that cryptocurrencies is an extremely disruptive place to be playing right now. I could totally see something there happening. I just don't know if there's enough wealth amassed inside of crypto to really make some massive black swan event happen if something happened in that space. But I think it's disruptive. It could create some movement or some activity. There has to be a correction. You know, you can't stay on the incline we're on forever, right? Like at some point there's something. I just don't believe that it's going to be in real estate or finance.
Yeah, you know, I referenced Greg Geiser earlier. We meet every 2 weeks and talk about the marketplace, and they buy, fix up, and flip about 500 homes a month. And so they're big players, and they look at certain numbers that indicate what tomorrow is going to look like or the next year or two. And It's, how many offers on, how long their listing stays on the market, how many offers they get, what percentage of list price are they getting, what concessions are being asked for. He's still seeing a tremendous amount of strength. And my personal opinion is, you get that perspective. We had the demand discussions about how underwater we are in terms of serving the communities. You gave some stats about, new permits compared to people coming into the states. Interest rates, even with 3 rises, are still going to be, high 3s, low 4s. I got to tell you, like when it relates to real estate, I just have never been more bullish. Like, and that's always a scary thing to say when you're talking to other people. I'm not telling everyone to run out, take all the money you have and go buy real estate, but I'll tell you that I'm heavily invested in real estate and continue to be heavily invested in real estate, and have never been more confident about that position in real estate. And I've been doing it a long time. And, it's always been, there's always a little cloud over every period of investing. If I can get through this, if I can do this, then this can work out. It just seems like the runway is long and it's wide for those willing to take the step. And maybe fear, oh, rates are going up, I'm going to wait for them to come down. Oh, real estate has gone up so much, I'm going to wait for a pullback. You hear that a lot. And I think kind of like what you said about people leaving the States, there's an opportunity while people take a step back to kind of jump in and snag a good piece of real estate.
Absolutely.
Gina, how about some Q&A before we wrap up? I know there's probably a number of questions that want to get answered. And then for any of those who have a question that don't get answered, Eddie and I, together or apart, will make sure that we get those back to you.
Absolutely. So one of our questions, this is for you, Eddie. You mentioned you sold 70 businesses last year or in 2019. The question is, are you considering each property you own as a separate business, or do you actually own that many unique businesses with employees, et cetera?
Yeah. So at that point in 2019, I owned 86 companies. Those were actual physical companies with employees. Those are not assets. I actually don't count the LLCs that hold my, assets as companies at all. I might count a property management company that I own that's managing some of those assets as a company. But no, that was those were real estate. I did have some real estate companies in there, but for the most part, those 76 I sold, about 7 of them were in the insurance space. A dozen of them were in publishing and television. There were a bunch of tech companies that I sold. I'm a business entrepreneur and love to build any type of business that's out there. Today, I still own about 14 companies. I own a coffee roastery. I own ThinkRealty. I own the American Association of Private Lenders. I own a capital raising company, which is Regal Coast Capital. I own, I own various other companies, a technology company out of California, Newport Beach. I own a bunch of companies and they all have people.
Part of the question was on your real estate. Do you look at each real estate asset as a business itself, or do you look at your entire portfolio and make portfolio decisions?
I make portfolio decisions. Yeah. I do not look at them as an individual. Now, there is a business, not like, for instance, right now I'm looking at a 48 unit new build here in Southwest Florida. That'll all 48 units will be short-term rentals, and it'll have a small marina in there, a pool, a restaurant, and some commercial. I look at that as a whole as a business. So I build a pro forma out, look at cash flow opportunities there. And I may parse that one out as a business because it's kind of this separate entity that I'm building. But no, my holdings, those 4,000 doors, I look at it as a kind of an ecosystem portfolio type piece.
Thank you.
For more of the beginner real estate investors who are just starting out, what advice would you give someone who's just starting to get their real estate investing business off the ground? And on top of that, what do you recommend as their first step to develop their strategy?
Eddie, I'll let you go first. And I have a quick and easy answer for that.
Me too. One of the things that I built ThinkRealty for that purpose is to just try to educate and help real estate investors. The reason we called it ThinkRealty was because I think that real estate assets are one of the greatest opportunities to build wealth in America. When you're thinking stocks or bonds or mutual funds, I wanted you to think realty. That's where the name came from. And so I think that the best thing to do is to take what you have, savings or your own assets, leverage them to the degree that is safe, and go buy another cash flowing asset, an appreciating cash flowing asset. I'm not going to set any bars or standards for that, but go out and do that, because the more assets you accumulate, the more opportunities you have. When I had 10 doors, I had some opportunities. When I had 100 doors, I had lots of opportunities. I have 4,000 doors. I have more opportunities than I can ever consider coming at me, from financing to new deals, to new opportunities, to aggregations, to all these different things. Deals beget deals. Get into one. And I always recommend getting into a buy and hold type strategy, because it's a long-term strategy versus a brand new investor jumping out and trying to flip a house. Every real estate investor you talk to, it's like, how was your first flip? And every time I was like, it was a disaster. I lost money, right? And if you buy right and you hold and you find a tenant to pay the mortgage, and you have some opportunities there for cash flow, you'll put yourself in a position where in 2 or 3 years, you can leverage those assets and keep growing them. It's a slower growth pattern, but it's a more sustainable one, and it's one that really will create a long-term wealth, over your lifetime.
Yeah, and I think sometimes people think about flip is I buy it, spend 9 months rehabbing it, and then I sell it. And flips can take 2 or 3 year time horizons as you get through that marketplace and you find a renter that's willing to cash flow. The only thing I would add to what Eddie said is that I do think relationships are everything in real estate. So, don't be grinding the real estate agent for smaller commissions. Don't be grinding your loan officer to try to squeeze a quarter point out. Don't grind your contractors and pay them less. Pay them more, pay them on time, give them some incentives to get their stuff done. You want people to pick up your phone and prioritize you over everyone else because you've taken care of that relationship. And I just have found in my time in real estate that those that you take care of more than they deserve will give you back way more than you deserve. And I think it's a fool's man's game to just grind all of those vendors and associates, especially in a time like this. So, the shortage of contractors and goods and services, that those end workers of the rehab are picking and choosing the developers that took care of them over time, and some of the new people coming into the game end up getting skinned, either through delays or lack of experience or extra costs or whatever. Good question though.
So Eddie had mentioned that he loves the southern states, and one of our viewers is asking, in regards to your current investing in Florida, are you seeing any hurdles there as far as the supply and demand goes?
My biggest hurdle here is supply chain and systems bogging down, where we used to be able to, we're buying lots here in Cape Coral, Florida by Fort Myers, and buying saltwater lots. I used to be able to get a seawall built in 2 or 3 months. Now we're 12 months out on building seawalls. My pool vendor, that used to build pools in 30 days, they're not even digging pools for 6 months, and you got to put your deposit down. We have a huge opportunity here when we build hurricane-proof houses. There's tax credits, all kinds of opportunities here. But the supply chain is really the biggest issue and hurdle we're facing here. There's a block shortage in South Florida, struggling to find things like garage doors, granite, but all those hurdles are not hard to overcome. I think, to Bill's point, building relationships, my actual developer here, the builder, he's building 200 to 300 houses this year. So he has been very, very diligent in finding other supplies, other opportunities. And then, a quick plug for ThinkRealty. We've got this discounts program out there, and we use, as a part of that, we've got Mohawk flooring and GE appliances and Benjamin Moore paints. And so because they're big national suppliers and we have leverage with them and buying power, we've been getting a lot of our supplies faster than the other homes that aren't using programs like ours. So those are the biggest hurdles I'm finding right now. That and just how fast things are moving. A lot that I could buy for 100 grand last year, I can buy for 300 grand this year. And now it's going up to, and I know that that same lot will be 400 grand next year. It's like, if you're buying lots on water down here, the appreciation of land is just, it's crazy.
Eddie, I didn't know that about your firm and the partnering up some of those vendors. The first 5 years of Civic's existence was underneath Wedgwood, and Wedgwood spends about $100 million a year at Home Depot. So they got what's called, it goes inside of the contractor's discount with a QR code. So what we thought of back then, similar to you, is bring that QR code into Civic and then pass it on to all of our investors, which is a value add, right? It's not just interest rates and points and fees, but what else are you doing for the investor to help them on their transaction? And so we do something similar, but I love that. I mean, that is giving back. And that's kind of how we feel. Like, how do you help the investor aside from providing financing? Sure.
And ThinkRealty has about 1 million real estate investors that touch the platform, on a regular basis. And so it creates, buying power. We send almost $30 million in paint spend to our paint vendors a year annually, 30 million. And then, for Sunbelt Tools, I think we do almost 100 million in tool rentals or, equipment rentals. Home Depot, it's almost 100 million. And so when you get that kind of buying power, UPS, we have the cheapest rates you could ever imagine on UPS, and we just pass it along to the free ThinkRealty. You get the ThinkRealty membership for free. And you get all the discounts with it. And so there's really no hurdle to get to it. And again, we're just trying to create and aggregate real estate investors to try to give them a benefit back, that if we all together buy, we get opportunities together. So that's what ThinkRealty is about.
That's a good way to end it.
Well, we have several other questions, but I know we're wrapping up on time. Bill, do you have any final questions for Eddie before we wrap?
No final questions, but I would encourage everyone to go to ThinkRealty and become a member. I am doing that right now. I mean, Eddie and I are connected in a lot of different ways, but I am personally, not just corporately, going to get involved in that. It's just, it goes beyond just good content. And so everyone should be a member there. And then just Eddie, thank you. Thank you for sharing your experiences and your insight and guidance in this space. It's what it's all about. And nobody was on this call that didn't walk away feeling like they got a couple nuggets that's going to be game changing for them in 2022.
Thank you, Bill. I appreciate it. I've appreciated Civic and the marketplace, having ownership of American Association of Private Lenders. My grandfather, the industry of private loans and hard money back in the day, for my grandfather, he called them shark loans and everything else. And this industry has come a long way. Nice. And it's come a long way because of great players in the industry like you and like Civic that hold a high level of ethics and desire to help the real estate investor and really have the real estate investor's best interest out there. And so thank you guys so much for being leaders in the industry and all that you do as well.
Thank you, Eddie. Appreciate that.
Well, thank you both. And thank you, everybody who's joined to participate today. Like Bill said, we don't think there's anybody who's not walking away today without some golden nugget that they can take with them in your real estate investing journey. So thank you, Eddie. It's been a privilege. And thank you, Bill. And everybody mark your calendars, because we're doing this again next month, Tuesday, February 15th. We are going to have Tony Watson joining us. If you saw him join us last year, he is our tax guru for the real estate investing community. So
we got a second
don't miss
one.
that.
It's Eddie.
We do. All right, everybody.
Appreciate you, Eddie.
Have a great day. Bye, everyone.
Bye-bye.